How's everybody doing? Welcome to the Strategy Room. It's Saturday night, and I hope everybody is having a great time out there. I have a whole bunch of good stuff for everybody tonight. But you are with Dr. Joe Berquist here, like as always, in the Strategy Room. It is Saturday night, November 23rd, 2024. So I'm going to open it up here. I'm going to kick it off with this article right here that I saw yesterday. I have no money. Thousands of Americans see their savings vanish in the Synapse fintech crisis. So this was something I had reported on in a few episodes over the last couple of months. Synapse Financial Technologies is basically like a fintech company that failed a few months back, and they basically provided outsourced services for a number of banks around the country. Perhaps the biggest bank involved in this, Evolve Bank and Trust. But I just want to get in here. There's a couple of key points in this article that I wanted to share with everybody because this is really big. But let's take a look at some of the key takeaways here. So thousands of Americans will receive little or nothing from savings accounts that were locked during the collapse of fintech middleman Synapse. Customers believed the accounts were backed by the full faith and credit of the U.S. government. This is key. I'm going to get more into this in a second. CNBC spoke to dozens of customers caught in the predicament, people who have lost sums ranging from $7,000 to well over $200,000. While there's not yet a full tally of those left shortchanged at FinTech Yoda alone, 13,725 customers say they are being offered a combined $11.8 million despite putting in $64.9 million in deposits. Now, if everyone will recall, when I reported on this, you had something in the neighborhood of about $80 to $90 million in deposits that were just completely missing. And everybody pointing the finger at each other, and Synapse basically filed for bankruptcy, closed up shop, laid off all their employees, and they just, wiped their hands of it and walked away. And then that left all the banks high and dry. And they basically said, well, we can't release people's money, but we can't because we can't get into the system because Synapse turned everything off. And then a couple of the, I guess, Synapse employees did go back in. I guess they gave the banks the ability to access the system. But then even after the banks got back into the system, they still had all kinds of discrepancy. Money was still missing, and they just didn't know what to do with it. So it's kind of, it has turned into this giant mess. And now you're in this situation where a lot of these consumers are basically not going to get their money back because they thought that they were doing business with a bank and they thought that their accounts had FDIC insurance on them. Neither of those things are true. You were not dealing with a bank and you did not have FDIC insurance. And that is the big thing that I want people to take away from this. For the most part, I don't know that it's absolutely 100% true, but 99.9% of the time, the only financial institution that is going to have FDIC insurance is a bank, or maybe like Morgan Stanley. It's kind of funny. There's an ad there, but they actually just popped into mind. Goldman Sachs, Morgan Stanley, I do believe they all have banking charters now. So they probably have FDIC insurance on a bunch of their products. But, a lot of these fintechs, PayPal, Block, this, what am I thinking of? Chime. I'm thinking this thing, this Yoda, Yoda, not the Star Wars Yoda, but not Yoda, Yota, YOTTA. It's a fintech app. But these things, again, like I said, Block, PayPal, people that like to use Venmo, people that like to use Cash App, you are keeping your money at fintech companies that are not banks and they are not FDIC insured. And, you better be really, really careful. And I hope that this whole mess finally wakes a lot of people up to the fact that you have to be very, very careful about where you're putting your money, because when these things go bust, you're not going to get your money back. You're going to be out. And let's look at, and this article does offer a couple of examples here. So for 15 years, former Texas school teacher Kayla Morris put every dollar she could save into a home for her growing family. When she and her husband sold the house last year, they stowed away the proceeds, $282,000, in what they thought of a safe place, an account at the savings startup Yoda, held at a real bank. Morris, like thousands of other customers, was snared in the collapse of a behind-the-scenes fintech firm called Synapse and has been locked out of her account for 6 months as of November. She held out hope that her money was still secure. Then she learned how much Evolve Bank and Trust, the lender where her funds were supposed to be held, was prepared to return to her. We were informed last Monday that Evolve was only going to pay us $500 out of that $280,000. Moore said during a court hearing last week, her voice wavering. It's just devastating. The crisis started in May when a dispute between Synapse and Evolve Bank over customer balances boiled over, and the fintech middleman turned off access to a key system used to process transactions. Synapse helped fintech startups like Yoda and Juno, which are not banks, offer checking accounts and debit cards by hooking them up with small lenders like Evolve. In the immediate aftermath of Synapse's bankruptcy, which happened after an exodus of its fintech clients, a court-appointed trustee found that up to $96 million of customer funds was missing. The mystery of where those funds are hasn't been solved, despite 6 months of court-mediated efforts between the four banks involved. That's mostly because the estate of Anderson Horowitz, backed Synapse, doesn't have the money to hire an outside firm to perform a full reconciliation of its ledgers, according to Jenna McWilliams, the bankruptcy trustee. But what is now clear is that regular Americans like Morris are bearing the brunt of that shortfall and will receive little or nothing from savings accounts that they believed were backed by the full faith and credit of the U.S. government. The losses demonstrate the risks of a system where customers didn't have direct relationships with banks, instead relying on startups to keep track of their funds, who offloaded that responsibility onto middlemen like Synapse. And this person says this is reverse bank robbery. There are thousands of others like Morris. While there's not yet a full tally of those left shortchanged, at Yoda alone, 13,725 customers say they are being offered a combined $11.8 million, despite putting in $64.9 million in deposits. CNBC spoke to dozens of these customers caught in the predicament, people who are owed sums ranging from $7,000 to well over $200,000, from FedEx drivers to small business owners, teachers to dentists. They described the loss of years of savings after turning to fintechs like Yoda for the highest interest rate on offer, for innovative features, or because they were turned away from traditional banks. One Yoda customer, Zach Jacobs, logged onto Evolve's website on November 4th to find he was getting back just $128.68 of the $94,468 he had deposited, and he decided to act. The 37-year-old Tampa, Florida-based business owner began organizing with other victims online, creating a board of volunteers for a group called Fight for Our Funds. It's his hope that they gain attention from press and politicians. When you tell people about this, it's like, there's no way this can happen. Jacob says, a bank just robbed us. This is the first reverse bank robbery in the history of America. But that's the problem. A bank didn't just rob you. You weren't just robbed by a bank. The problem was you didn't do your homework. The problem, I hate to say that. I hate to say that. I don't mean to be mean, but the problem is, you put your money in the hands of a fintech that did not have FDIC insurance. They may have had some kind of affiliation or, with the bank, but ultimately you were working through this fintech app, thinking that like, oh, well, I have my money in the bank, and you didn't. I don't know why you wouldn't just go down to the bank and open a bank account. Like, and it's a shame. And I feel for these people. I really, truly feel for these people, because this is horrible. I mean, it's horrible that this happened to them. And I hope eventually they're able to figure it out. Hopefully the money is there, and they just need to get somebody to come in and do like a forensic audit and figure this thing out. But the reason why I just wanted to point this article out was just because I just want people to be aware and just be very careful about what you're doing with your money. What are you doing with your money? What are you doing with it? How, where are you storing it? Now, and again, and there is, to be fair, I mean, there's no perfect solution, right? You can't, I mean, even if you put it in a bank, there's always a chance that the bank could fail. There's always a chance that something could happen with the deposits, and you don't get bailed out. I mean, if you have $1 million sitting in the bank, and the FDIC fund only covers up to 250,000, well, and that bank fails, you could be out $750,000. That's the reality of the situation. And now, nobody ever expects that the bank is going to fail. But unfortunately, we have almost 250 years of history of bank failures in this country. So it is possible, and it can happen. So, but like I said, I just wanted to open up with this. I thought this was a huge story that I saw yesterday. And I do think that there will be more attention on this. And we've already felt the repercussions, and this has reverberated throughout the banking landscape now, as regulators have taken a much harder look at some of the things that banks are doing with fintechs and how they're operating with fintechs, the nature of those relationships, the nature of the contracts. What do banks do if a fintech does blow up and fails or files for bankruptcy or whatever the case may be? How do banks handle that? What are they doing with it? So this is going to have repercussions for a long time to come. So, okay, now let's move on. A couple other big things here. We had the Trump administration announced their pick for the Commerce Secretary. They also announced their pick for the Treasury Secretary. So let's take a look at this. Both of the gentlemen involved here. So Howard Lutnick was the one gentleman. The other gentleman is Scott Bessent. And so they were both basically vying for the Treasury Secretary job, but ultimately Scott Bessent got the Treasury Secretary job and Howard Lutnick got the Commerce Secretary job. But what does this mean potentially for the economy? So let's take Howard Lutnick first. Let's look at this. So President-elect Donald Trump selected Cantor Fitzgerald CEO Howard Lutnick as Commerce Secretary. Lutnick will oversee several important government agencies and help promote U.S. business growth and economic development in the role. Trump will likely rely on Lutnick to help implement his proposals to raise tariffs on trade with foreign countries. President-elect Donald Trump is turning to a Wall Street veteran and key campaign supporter to join his cabinet as a top business advisor. Trump confirmed Tuesday that Cantor Fitzgerald CEO Howard Lutnick is his choice for Commerce Secretary. Lutnick has been serving as the co-chair of the team managing Trump's transition to the White House. In the Commerce Secretary role, Lutnick would represent U.S. businesses on the president's cabinet while also promoting job growth and economic development. The Commerce Department's oversight includes agency and organizations that help promote U.S. business and the economy, including the Bureau of Economic Analysis, the Census Bureau, the National Oceanic and Atmospheric Administration, and the Patent and Trademark Office. Lutnick will help enact Trump's tariff proposals. Tariffs are one issue. In a recent podcast interview, Lutnick said tariffs could replace income tax revenue, potentially offsetting that revenue source over time. But we'll see. But here's what I do hope. Bureau of Economic Analysis, the Census Bureau. I mean, I hope we start getting better numbers out of those places. I hope they start reporting better numbers. We start getting more honest numbers and not good headline numbers and then major revisions every month thereafter. So I hope he goes in there and kind of cleans house and we start getting numbers that are real, that we can rely on and depend on. And we're not going to just get constant downward revisions every month. So that's one thing. It's one hope. So, okay, now we get to Scott Bessent for the Treasury Secretary. So President-elect Donald Trump signaled Friday his intention to nominate hedge fund executive Scott Bessent as his Treasury Secretary. Trump, in a statement, called the prospective nominee one of the world's foremost international investors and geopolitical and economic strategists. Trump's decision to name Bessent to the key position follows a week of intense speculation about who would win out. So who is Scott Bessent? So he's a hedge fund executive, Scott Bessent, as his Treasury Secretary, in a move that puts a seasoned market pro and a close Trump loyalist in a critical economic position. The founder of Key Square Group had been considered a strong favorite for the position, along with a few other close contenders, including former Fed Governor Kevin Warsh and private equity executive Mark Rowan. As head of Treasury, Bassett, 62, will be both the U.S. fiscal watchdog as well as a key official to help Trump enact his ambitious economic agenda. Both a Wall Street heavyweight and advocate for many of the incoming president's economic goals, he would come to office at a critical time as the U.S. wrestles with a growing economy alongside long-festering debt and deficit issues. Trump, in a statement called the prospective nominee, one of the world's foremost international investors and geopolitical and economic strategists, Scott's story is that of the American dream. Like Trump, Bassett favors gradual tariffs and deregulation to push American business and control inflation. In addition, he has advocated for a revival in manufacturing as well as energy independence. If you're going to think about the market and think about what matters, the guy is brilliant, said a source familiar with Trump's thinking, who spoke on condition of anonymity to talk frankly about the matter. There aren't many people who know the market better than Bassett does. The prospective nominee also has deep philanthropic ties through Yale University, along with Rockefeller University and the Classical American Homes Preservation Trust. One obstacle Bassett will have to overcome is his past affiliation with billionaire investor and global progressive GladFi George Soros. He's Soros' chief investment officer for Soros's fund. Trump, though, said Bassett will support my policies that will drive U.S. competitiveness and stop unfair trade imbalances. Trump's decision to name Bassett to the key position follows a week of intense speculation. We already heard that. Putting Bassett in the Treasury job could clear the way for Warsh eventually to take over at the Fed, though he is also thought to be a contender to head the National Economic Council. The Treasury Secretary is the linchpin for the White House economic agenda. Yes, I would agree with that. So here's some of the things about Scott Bassett that I think people need to understand. So number one is it is universally agreed that the guy is a brilliant guy. Whether it's the Republicans or the Democrats, everybody agrees this guy is a brilliant guy. He's had a long career on Wall Street. Been an incredibly successful guy, really knows his stuff. He's been been on CNBC a million times, been on Bloomberg a million times, Fox Business, been quoted in the Wall Street Journal, Economist, on and on and on and on. So nobody doubts this guy's capabilities. Nobody doubts his qualifications. Nobody doubts his intelligence. Like, none of that is in question. I think this guy is a great choice for the job. The George Soros thing, I mean, people on the right are undoubtedly going to have an issue. They're going to have an issue with that. I think there's probably some other backstory on that, but I think eventually, though, people will be fine with this and they'll move on. But here's my big takeaway on this. People do not understand, and I have talked extensively about this on many of the live streams and a number of the episodes that I've done. Janet Yellen has manipulated in an incredible fashion the Treasury markets especially over the last year. And she's now kind of just started to kind of let it go because, she knows she's about to walk out the door. And I cannot explain. Few people truly understand the colossal mess that Janet Yellen has left for, whoever the next person was going to be. In this case, it's going to be Mr. Bassett. Bassett. He has got a monumental task in front of him, and I don't envy this guy. This guy has got the job of all jobs in front of him, because I think 2025 is going to be a very tough year, because he is going to have to deal with an out of control national debt. How do you finance that? He's going to, China and Japan are somewhat on the sidelines. They're not buying our national debt at the moment, or at least not buying very much of it. He's going to have treasury rates that are going to be going up. He's probably going to be, I would not doubt for 1 minute. I've said for a long time, Janet Yellen and Jeremy Powell, the two of them, thick as thieves. Janet Yellen, remember, she ran the Fed and she worked hand in hand with Powell for many years at the Fed before, she stepped down, and then Jeremy Powell became head of the Federal Reserve. She went away for a little while and then came back under Biden as head as the Treasury Secretary, and has now run the Treasury for the last 4 years. But her and Jeremy Powell, they're besties. They're besties, best buds. They're the two of them are thick as thieves. and they worked in conjunction here. That's not the case with Mr. Bessent. I would not. It would not shock me one bit if Mr. Bessent and Mr. Powell started clashing, started butting heads right away. Because Jeremy Powell has been on this. He's been all, oh, we're going to cut rates, and we defeated inflation. We're going to cut rates. We've been bringing the balance sheet down at the Fed. Well, if Mr. Bessent comes back to Mr. Powell and says, "Hey, hold on there. We need you to start, maybe not forget the tightening for a while. Stop doing the runoff on your balance sheet because we need to stabilize a couple things over here, and maybe we need a pause in the interest rate reductions. So maybe take a chill until rates kind of even themselves out a little bit." And then, we'll see what happens with that. Will Jeremy Powell then do a complete pivot and turn away from that and basically say, I'm not doing that, or I'm not playing ball, whatever. So, we'll see, we'll see what happens there. But like I said, we now have Scott Bessent for Treasury Secretary. We have Howard Lutnick now for Commerce Secretary. So, some of these key cabinet positions starting to fill up here, and we'll see what happens. But let's run through a couple other articles here real quick, and then I'm going to get into some of my more normal stuff. I'm going to run through the episodes I did this week. Going to run through economic indicators, things coming up this week. It's not a lot this week with Thanksgiving coming up on Thursday, but we have a couple things playing out. So I'll go in all that. I've got a bunch of banking news. I've got a bunch of industry related news coming up a little later. So we'll go in that, but let's run through a couple of these articles here real quick, and then we'll get back to business with some of the usual stuff that we go through here. So, okay. Federal court strikes down the overtime pay change. Here's what it means for employers. Basically, the Department of Labor's attempt to extend overtime eligibility to millions of new workers has been struck down in court. The United States District Court in the Eastern District of Texas found the Department of Labor overstepped its authority under the Fair Labor Standards Act to raise minimum salary levels high enough that it essentially made an employee's duties, functions, or tasks irrelevant to whether their duties qualified them for overtime. The rule at hand, which was finalized by the Department of Labor in April, increased the annual salary threshold under which non-exempt workers are eligible for overtime pay from $35,000 to $43,000. That change took effect July 1st. On January 1st, the threshold would have increased further to $58,000. The salary threshold then would have updated every 3 years based on wage data. Over the first two updates, more than 3 million workers are expected to become newly eligible for overtime pay, the agency said. Business groups, including the NFIB, celebrated the court's ruling. Employers had argued the rule would significantly increase costs and create staffing issues for businesses, which are already grappling with higher labor costs in the wake of the pandemic. Yes, you think? Who do you think this would have buried? This would have buried restaurants. Restaurants would have been buried with this news. So this was, I think this was a good thing. I think this was a good thing that this got shot down. Yes, are people going to be upset that, they could have made more money working overtime? Yes, absolutely. But you have to look at the larger implications. Like, you're already seeing, especially like in hospitality, retail businesses, the increased cost to them for their payrolls, for their labor has been immense, and it has crushed their margins. And look at all the restaurants that have filed for bankruptcy this year: TGI Fridays, Red Lobster. The list it goes on and on and on. And why is that? Because restaurants operate on very thin margins to begin with. They operate, even if you have a brand new restaurant that is absolutely fantastic, and it, say not like upscale, but somewhat upscale, and you're still operating on these razor thin, 3, 4, 5% margins. I mean, very thin margins. So you massively increase these overtime expenses, and guess what? They can't afford to have as many staff on. It's like I walked into a Red Robin, and I was fascinated because there was a line out the door, and I'm thinking, oh man, this is great, man. Red Robin's packed. I love seeing it. I love, people are coming out, they're spending their money, whatever. And then I get into the restaurant. Half the restaurant is empty. And I'm like, what's going on here? Why is half the restaurant empty? Oh, well, they either can't find the staff or they can't afford to hire the staff. So what appeared to be great actually was not so great. You had half the restaurant full and a line out the door because, like I said, they either couldn't find or couldn't afford to hire enough staff to fill the whole restaurant. And I think that's a perfect example of what's going on in the market today. And again, I think this was good. I think this was a good move here, and like I said, a good move on the part of the court. Very, very typical of this current administration, just kind of overstepping their bounds constantly with like everything. But okay. Next thing, the white collar job market hits a new normal and everyone hates it. The job market continues to cool down from its COVID era highs and is settled into a new normal. Workers in the market for a new job right now are probably frustrated by it. Many employers are also feeling frustrated of their own, as the majority of companies with openings report challenges finding the talent they need. If I had to sum it up in one word, it's competitive. We've got pressure from every dimension, said David Fano, a former WeWork chief growth officer and CEO and founder of artificial intelligence career platform Teal. Fano said the reasons for that are numerous, including a growing number of older workers who are retiring later, in addition to retired workers re-entering the workforce, and companies that are right now less interested in hiring than they are in retaining current workers. That includes a pullback on hiring entry-level workers. Additionally, workers who are uncertain about the future are deciding to stay put in their jobs, a phenomenon experts have called the Great Stay. So we went from the Great Resignation to the Great Stay. That in turn has reduced the pressure companies faced a couple of years ago to offer much bigger raises and higher salaries, and as was the case in the tech industry, to cut tens of thousands of workers to boost the bottom line. I do want to add a little caveat on that. The tech industry overhired. They dramatically overhired. And as a result, you had what a lot of people saw. You had the TikTok videos of the workers literally walking around doing nothing all day long, getting paid $200,000 a year to make TikTok videos, to show up at work, eat lunch, eat breakfast, eat lunch, get a Frappuccino, drink wine on the roof, text for a little while, do some posts, do a little live streaming, and then hit the bar to party it up with the friends at nighttime. So that didn't work out so well. Big tech realized they way overhired and cut loose basically all those employees. But also I would say this too: do not discount what happened at X, formerly Twitter. Elon Musk going in there and cutting basically 80% of the workforce, 80%, and basically the company not missing a beat. That opened a lot of eyes. A lot of people, what ultimately happened there was a lot of people sat there and basically lamented it in the press. But in the business world, a lot of people were like, wow, he just cut 80% of his workforce. And company didn't miss a beat. Maybe we need to start looking around at, some of the people in here. So, believe me, everybody took notice of the fact of what Elon had done there and the fact that it didn't harm the company one bit. So those are some other things that were at play in there. But anyway, so we got the Great Stay now. So that in turn has reduced the pressure companies faced a couple of years ago to offer much bigger raises and higher salaries. And as was the case in the tech industry, to cut tens of thousands of workers. In particular, many companies that hire remotely are finding huge demand for those positions, increasing competition for a smaller set of jobs. That's because pretty much everybody now wants to get everybody back into the office. You've got pressure from the top and the bottom and the sides, which has resulted in it being a far more competitive white-collar labor market. But that competition isn't always translating into an easier time for businesses. The most recent jobs report from the National Federation for Independent Businesses found 87% of companies that are hiring reported few or no qualified applicants for the positions they were trying to fill. While not quite as challenging as during the post-pandemic labor shortage, the survey is illustrative of a hiring market that remains relatively tight compared to pre-pandemic norms. Experts have been warning businesses that tightness is expected to stick around due to a large part to shifting demographics. And then it says here, job openings vary widely by industry, and this all comes back. So the labor market right now is very complicated because I think number one is the labor market is nowhere near as strong as we think it is. As like I said, as I've talked about before in some of the job reports data that I've gotten into on the channel, is you have some big things. Your white collar 6-figure jobs have actually been negative over the last couple of years. You've been losing those really good jobs. Meanwhile, all the big bulk of the jobs that have been created have all been part-time jobs. I mean, 90% of the jobs created in the last 2 years, part-time jobs. But here's the worst part. Those jobs have all been going to foreign-born workers. And we all know what that means. Foreign-born workers, not citizens, foreign-born workers. That's a big problem. You've got people in the economy who are working, 2, 3, 4 jobs to try to make ends meet. It's not this. I've been saying for months and months and months, this labor market is nowhere near as strong or as good as people think it is. And then you've got the whole issue of ghost jobs. You've got people out there, or you got companies out there that put these job postings out there, and that with no intentions of hiring. And I've reported on that. I did an episode on ghost jobs where almost half the jobs out there could be potentially ghost jobs. I mean, it's a staggering number. So there's a little bit of update there on the labor market. Let's see what else here. So let's switch gears to SBA for a second. So SBA's non-bank lenders could see strict oversight. Here's what it means for businesses. So the Small Business Administration's efforts to include more non-bank lenders will see greater scrutiny in 2025. That's after a new report by the SBA's Inspector General found that while the COVID-19 era Paycheck Protection Program was meant to get aid quickly to small businesses, it was non-bank lenders that processed an outsized number of potential fraudulent loans. The same report pointed out that the SBA has since extended licenses to non-bank lenders, some of which were the same that had potentially high cases of fraudulent loans issued under the PPP. Yes. So let's talk about this for a second. Okay, here's what the issue is with this. So during COVID, you had the PPP loans. Banks were doing the best they could to get these PPP loans out as fast as possible. The SBA basically went back with a recommendation to the government because the government felt that the banks still weren't getting these PPP loans out quick enough. So the SBA came out and said, let's open it up. Let's give some of these, non-bank lenders, let's let them make the PPP loans. That turned out to be a major, major mistake because the non-bank lenders ended up putting out about somewhere in the neighborhood of about 20 to 25% of all the PPP loans came out of these non-bank lenders. When they did the analysis, they found that basically 80% of the fraud had come out of these 80% of the fraud that they found so far in the PPP loans came out of these non-bank lenders. So that turned out to be a huge mistake in letting these non-bank players come in to this world, the SBA world, if you will. Then the SBA, in their infinite wisdom, decided that after they knew this for a fact, after they had this information, that they were going to open up all their other programs to these non-bank lenders. You could see the train wreck a coming. So what did people feel about this? So Senator Joni Ernst, Republican from Iowa, ranking member of the Senate Small Business Committee, stressed the potential dangers posed by non-bank lenders. Ernst and other senators have expressed concern and skepticism about the SBA's non-bank efforts in hearings over the last few years. I have been raising the alarm about the SBA's expansion of the 7A loan program and failure to vet new non-bank lenders, Ernst said in an exclusive statement to the Playbook. Unfortunately, it appears I was right. Non-bank lenders were responsible for more than $14 billion in suspected fraud in the PPP program alone. Expanding their reach and taxpayer-backed programs is a problem. As the incoming chair of the Senate Small Business Committee, I can promise that accountability is coming and there are going to be consequences for bad actors and lazy regulators. The $14 billion cited by Ernst was the sum of suspected fraudulent loans noted in the IG's report, with the IG pointing out that non-bank lenders were 5 times more likely to issue fraudulent loans than traditional banks. I'm shocked. I can't believe, how could that be? There were 5,322 lenders that engaged as part of the PPP initiative, issuing 11.46 million loans for a total of $792 billion. With SBA encouragement, non-bank lenders signed on and ultimately accounted for just 186 of those lenders. But those parties made nearly 3 million loans for a total of $61 billion. 7 high-volume non-bank lenders were found to have approved more than 18,000 loans per day, which translates to one loan every 5 seconds. In 2021, after having made fewer than 22,000 PPP loans total in 2020. The report found that while the SBA created a comprehensive plan to conduct risk-based reviews of lender iterations, its focus went instead to loan forgiveness oversight and its guarantee purchases of delinquent loans. It did not perform any risk-based reviews of lenders' operations during the program. So-called hold harmless provisions meant to encourage lender participation also protected them from consequences, the IG said. SBA was unaware of the extent of the service provider's participation in the program and the related risks. SBA's limited oversight of lenders increased the risk of fraud and financial loss, the IG said in the report. Let me say that again. The SBA's limited oversight of lenders increased the risk of fraud and financial loss. The IG also found that non-bank lenders that use service providers to help process loans had a higher likelihood of being fraudulent, with a 16.2% suspected fraud rate compared to 4.9% for lenders that did not use a service provider. The SBA relied on lenders to perform their own due diligence on their service providers and submit a lender service provider agreement to the SBA. But 18 out of 20 lenders reviewed by the IG did not have an accepted LSP agreement. That's a big no-no. Got to have that LSP agreement. If you were a bank and you were using a service provider and you didn't have an LSP agreement, woo, baby. You got some problems. You got some problems on your hands. So why they let these non-bank lenders get away with it, I don't know. Okay, and then so basically it just goes on to state that so this is going to be a hot button issue, I think, a little bit at the start. I don't know who's going to be the new head of the SBA. But you can bet, I would be willing to bet that some of these things that they have been doing the last few years are going to be rolled back. And I have been critical of some of these things because, and the reason why I'm critical, and I've said this before, the SBA is actually a great organization. Believe it or not, they are one of the few government organizations out there that are actually profitable. The SBA actually makes money. It's the rarest of government agencies that actually makes money, and they have run a good program for a long time, but they have also been able to do that by being somewhat conservative in how they go about doing things, by keeping it to just banks, banks that understand their program and understand how to do things, and banks that they've been working with for decades and decades and decades. So that know and understand and have the working professionals, have the people on hand to do all the things they want them to do. And kind of just opening it up willy-nilly to all these other lenders like I said, is just a bad. The SBA made some bad moves during the whole COVID thing, opening the PPP up to the non-bank lenders. SBA making the EIDL loans themselves, which have turned into a giant disaster. And now again, now they wanted to open up all their, because the PPP went so well, they figured they needed to open up all their programs to these non-bank lenders. So this is definitely something now that they have this IG's report basically coming back saying, hey, this is not good. We found a lot of fraud, a lot of different things here, a lot of really poor oversight on behalf of the SBA. So that's not really going that great there for the SBA. So we'll see what happens. Stay tuned on that one. I'm sure over the next 6 months, we'll have a lot more news there. My guess is whoever the next SBA chief is going to be, my guess is they're going to roll a bunch of this stuff back, and they're going to take care of the EIDL problem. I will say on another note, I do think that the EIDL loans should be forgiven. And I had some great conversations with people on this the last couple of weeks. I had conversations with business owners that took out EIDL loans, and it's been very interesting, the response that I've gotten back. Now, some businesses are perfectly capable of repaying them, but they're stuck in a situation where the only reason they took out that EIDL loan was so that they could keep their employees. And then, so they took the loan out, paying, keeping the employees on hand, and then the employees up and left. And so they're basically like, oh, that's great. I took out this $100,000 EIDL loan to keep these 4 employees, and it was going great there for about 4 or 5 months. And then those employees all up and left me. And so I lost all 4 of those employees anyway. And now I'm stuck repaying this $100,000 loan. I can afford to repay it, but it's still now a debt that I have to repay. And I think the problem here, like here's where I see the difference. Like if you think about student loans for a second, I think the issue that I have with student loans is that nobody forced you to do that. Nobody forced you to go to college. Nobody put a gun to your head and told you had to go to college. Nobody twisted your arm. And basically, made you sign the student loan paperwork, filled out those applications for student loans, filled out the FAFSA. Nobody forced you to do that. You did that of your own free will. You went to school. Hopefully you earned your degree. And now that's your debt. That's your responsibility to pay that back. That is not somebody else's responsibility. And this fallacy that the government is going to forgive those loans. No, the government is just going to take that loan and make all of the taxpayers pay it back. So therefore, like I now become responsible for paying back everybody else's student loans. I don't think so. No, no way. But with the COVID thing, it was different. And what made it different was they did have a gun put to their head. The government locked them down. And then when they said, well, I'm going to lose my business is going to go bust. I'm going to lose all my employees. And then the government said, hey, no problem. We're going to give you these PPP loans. And if you need a little something extra, we'll give you the EIDL loan. So a lot of business owners, not knowing what was going to happen, ran out and took these loans out. And for a lot of businesses, this EIDL debt is going to crush them. It's going to put them out of business. And I just look at it from a perspective of, what would you rather do? Would you rather foreclose on these businesses and put probably tens of thousands of businesses across the country out of business? Or would it be better to just forgive the loan, say, forget it, let those businesses live to fight another day, and move on to the next thing? And I just think that right now, because of the fact that our labor market is not as good as many people think it is, I think that it would be a better move now to just forgive the EIDL loans and move on, and basically tell the SBA, SBA, love you, but don't ever do that again. You're not a direct lender. We don't want you to be a direct lender. You're never going to be a direct lender. So just do not ever do that again. Don't ever make that foolish mistake ever again. Leave it to the banks to do the lending, and you guys just do your guarantee thing, which you've been so good at for many, many years. I think that's, more where that needs to go. But we'll see. We'll see what happens. Okay. Speaking of that was like a perfect segue, right? Speaking of student loans, federal student loan changes spark unprecedented number of borrower complaints. Ooh. Student loan borrower complaints surged this year as required payments resumed and servicers struggled to implement numerous rule changes. Servicers gave borrowers incorrect information, delayed processing of important documents, and erroneously withdrew thousands of dollars from borrowers' bank accounts. Government watchdogs singled out Missouri-based Mohila as making disproportionately more errors than other companies. The massive changes to the federal student loan system in 2024 provoked a massive surge of complaints from borrowers, many of them about the companies that administer the loans. Yes, a lot of them suck. I had Navient. I don't think very highly of Navient. If anybody is dealing with Navient, I would tell them to check their statements and check them every month, because Navient did, I'll just say it this way. I wish I would have had just a little bit more money at the time, because I probably would have considered a lawsuit against Navient, like so many other people have done, because that company is shady. They are shady, and they do all kinds of messed up stuff. They literally, I had the one loan, and they literally just like stopped it. Like I had amortization, I had monthly payment, I had it all just set up. It was set up on auto debit, all that stuff. And all of a sudden, one month I see it's just stopped. And this is before COVID. Before any of the nonsense happened there with that. And it just stopped. And I call them up, and I'm like, hey, I noticed you guys didn't take out the loan payment this month. What's going on? And they had just turned it all off. And I said, and they said, oh, well, you contacted us and told us to turn this off. I said, no, I didn't contact you and tell you to turn that off. You guys need to turn that back on. I said, why would I tell you to turn it off? I owe this debt. I have this, I have it, it's a fixed loan. I have on umpteen, months for 10 years, whatever. And I got to pay this bill every month because I want to get this thing paid off someday. And so they're like, okay. So they turn it back on. The loan payment was wrong. The amortization was wrong. The number of payments they had it in there was wrong. And then I had to spend weeks basically get them to correct it. And the people I was getting on the phone were like, oh, this is no big deal. We just gave you, you had, your original note was for 120 months, and you paid 20 payments. You have 100 payments left. But we pushed it back to like 125. So we reduced your loan payment. So you're good. So now you're good. Whatever. And I stopped and I said, whoa. No, I'm not doing that, because that's a whole lot of extra interest that I'm going to have to pay. I don't want to pay it. And, hey, wait for it. I have this loan agreement. I have a loan agreement right here, written in paper. It says, this is my amortization schedule. This is my monthly payment. This is my fixed interest rate. It's all right there in writing. This is what I signed. If you want to change that, okay, without my author, you can't just, no bank, nobody can just go in there and arbitrarily change the terms and conditions of a written loan agreement. You can't do that's illegal. You can't do that. You get sued over that. And I basically had to go back and keep telling people there, if you guys don't fix this, I'm going to sue you, because you cannot do this. You cannot do this shady stuff. And finally, it got back to some manager, and once the manager got it, they fixed it right quick. But it was just infuriating. And I went through this for months. So just crazy stuff. So I would tell you, if you're dealing with one of these student loan service providers, check your statements every month, and watch that thing like a hawk, man. Be like, I'm watching you. All right. So then, so the Department of Education received 289,523 complaints in the fiscal year ending this September, more than double the 122,632 from the year before. The agency's Federal Student Aid (FSA) ombudsman said in a recent report this week. Over the same period, the CFPB received a record 13,524 complaints about student loans. The Bureau's own ombudsman, saying that right, ombudsman, said in a separate report. The reports highlighted how student loan servicers have struggled to implement the myriad of changes to the student loan system over the last year. Those included the resumption of required payments after the pandemic forbearance came to an end, the rollout of the SAVE repayment plan, which federal courts subsequently blocked, and many other rule changes. The reports also showed problems have persisted since the government punished student loan servicers for errors that affected borrowers in previous years. Student borrowers continue to face lengthy delays and costly errors because of servicer failures. So what are all the student loan complaints about? Borrowers were given incorrect adjustments to their accounts. Ding, yep, bingo. Told to make payments they didn't owe. Had money unexpectedly drawn from their bank account, and had crucial paperwork delayed. Often those errors had serious consequences for borrowers. Borrowers told the Bureau they were late on rent or car payments, lost eligibility for mortgages, and were even forced to the brink of homelessness. So yeah, big problem there. What do student loan servicers and advocates have to say? The department singled out Mohila, a quasi-government company authorized by the state of Missouri, as being a major source of complaints. Mohila services 18% of student loans on income-driven repayment plans, but 52% of borrowers' complaints involved income-driven repayment plans were about the company. This is more than just mismanagement. It's a betrayal of the public trust. You could say that. But yeah, that's basically it. So keep an eye. If you got student loans out there, keep an eye on stuff, because yeah, not too good. And let's see here. The housing market just bounced back for the first time in years. Sales of existing homes rose 3.4% in October and were up 2.9% year over year, the first annual sales increase since July of 2021. However, despite the uptick, sales remained well below historic levels, as high prices and mortgage rates have made payments unaffordable for many would-be buyers. Mortgage rates are currently near 7% and may dip to the 6% range in the coming months, but are unlikely return to the pre-pandemic range of 3 to 5%, one housing economist said. So, yes. So they saw an uptick in the sale of existing homes, but the sales remain well below historic levels, as we still have a major affordability issue. Okay. So that being said, okay, now let's get out of that for just a second. All right, I just need to take a break for a second here. All right, need a drink. All right, let's see here. All right, so I want to switch gears for a minute. Want to do a couple of things that I always do. I normally start out with this stuff, but I figured I'd get more into a little bit of a news to start with. So let's go with first. I always like to give everybody what are the economic indicators coming out this week. So we have kind of a short week with Thanksgiving. So what do we got? We got on Tuesday, we got the CB consumer confidence. We got new home sales on Wednesday, November 27th. We got the durable goods orders. We got GDP quarter over quarter. We got goods trade balance. We have the core PCE price index and good inflation indicator there. Pending home sales. The Atlanta Fed GDP now is going to be at 1 o'clock on Wednesday, and then nothing Thursday. And then Friday on November 29th, we just have the Chicago PMI. So very light, but some very key things coming out on Wednesday. Obviously, the GDP numbers and that core PCE, which is the Fed's preferred inflation index. So we will get those out and we'll see what's going on there. Now, thinking about some of the other inflation indicators, the CPI and the PPI, what we have seen there is that the numbers have been basically coming in line with where economists were looking, but have ticked up just a tiny bit. However, the core CPI, the core PPI have been increasing for the last 5, 6, 7 months. And that's not a good thing, because that shows that inflation has not been beaten. And that also goes to the case of, the Fed keeps saying that inflation is going to come back down to their 2% target. Is it? Because, we're not, as of right this minute, we're not really seeing that. And the Fed continues to cut rates. So, will we see a pause by the Fed, depending on, what keeps happening here? So I think that the PCE number that comes out on Wednesday will be a very kind of critical piece in the Fed's ultimate decision here, in December as to whether or not they're going to continue decreasing interest rates, but we shall see. Okay. All right. Let me talk. Okay, let me talk about episodes that I did this week. So here was what I had that came out this week. So I had episode 269. Yellen continues market manipulation. So basically, that whole episode was about where Treasury rates at now. What's happening? Why is it the Fed is decreased interest rates 75 basis points, but the 10-year Treasury is up 60 basis points since they started cutting? So it's basically almost at a break even. I talk about all about that. I talk about the kind of conditions at the current, at the Treasury right now, what's going on over there with some of their auctions and things. And that leads directly back to the comments I just made a little bit earlier about Scott Bessent becoming the Treasury Secretary and the monumental mess that he has inherited. Then I did episode 270. How are U.S. unbanked households doing? Some great statistics in there. U.S. bank households have been cut in half over the last basically 10, 12 years, which is a great thing. So because you have basically what's called unbanked households, and then you have underbanked households. So both those things not good. I mean, you basically want, and it's not necessarily just using a bank. It's just having the ability to have access to banking services and not having to do everything through like prepaid cards, check cashing places, that kind of thing. But basically being able to get a normal credit card, be able to take out an auto loan, be able to go into a bank, open up bank accounts, use bank accounts, that kind of thing is what they're looking at there. So a lot of great statistics on a lot of minority groups in the United States. But then also some really interesting statistics on just like the use of certain bank technologies, mobile bank. The use of mobile banking has increased dramatically in the last 3 years amongst all age groups, amongst all demographics. It's really quite interesting. The use of the bank tellers has gone like this, whereas the use of mobile banking has gone like that. So that report is not totally about just unbanked or underbanked households. You also got a lot of really good data and really interesting statistics and information in there. So, okay. And then episode 271, that was liquidation pressures led to the Republic First Bank failure. Now, obviously, earlier this year, I reported extensively on the failure of Republic First Bank. Republic First was a bank over in New Jersey that also had branches in Pennsylvania and New York. It was about Republic Bank was about a $5.6, $5.7 billion bank. So not the biggest bank in the world, but certainly not a tiny bank either. And they went bad. They had this major board drama. I called it as the Republic turns, because it basically was like a soap opera. That's how bad it was. But a very entertaining story. Certainly a great story to report on here. That's for sure. So I did a whole episode on that. They basically had an IG report that came out that did a whole investigation of the failure and basically said, yeah, they ended up with liquidity pressures because of unrealized losses they had on their balance sheet. And basically they tried to do a couple capital raises. They were unsuccessful in that. And then they had taken out advances on their line of credit, the Federal Home Loan Bank. And they'd also used what was called the BFTP lending program from the Federal Reserve. They were basically informed with both those facilities that they were cut off. They couldn't do any more advances. And furthermore, the advances that they had taken out, they had to pay back. And because they had to pay them back, that caused them to have to realize the losses they had in their bond portfolio through liquidation. And then basically they paid those advances back, and that left them with nothing. Their capital was depleted, and that is that is end game. That is, as they say, checkmate, end game, story over. So that was what I reported on in that episode. So, and then episode 272 was the new SBA COVID EIDL Servicing Center, otherwise known as the CESC, and the brand new My SBA Loan Portal. That was hugely popular episode there. I had a couple thousand views on that episode very quickly over the last day or so. So people obviously very good information there that people really liked. So that's good. And then finally, yesterday I had episode 273 that came out, which was basically a special report, federal home loan banks under fire. And I did a whole review of basically the federal home loan banking system, who they serve, why they do what they do. I covered a number of reports there and basically showed how they report to the Federal Housing Finance Agency, the FHFA. And the FHFA basically, just like so many people in the current administration, just completely overstepping their bounds. They just went kind of nuts, wanted to completely remake the federal home loan banks. And it just, I was just not in favor of that, not in favor of that at all. The federal home loan banking system is a system that has worked great for literally 100 years. It has changed in that. There are some critics on there, certainly some things that they could probably do a little bit better, like any other, government agency or quasi-government agency. Think of like Fannie Mae, Freddie Mac, the GSEs. So, again, nothing's perfect, but it's one of those things that's like, if it's not broke, don't fix it. So, so I have not been a fan of what's been going on there. I hope with the new administration that all this stuff basically goes away and they just leave the federal home loan banking system alone, because those guys are fine. They do a great job. Nothing wrong with it. Just let them keep doing what they're doing. Okay. And now, real quick, so what's the plan for this week? Since we have the holiday Thanksgiving coming up on Thursday, I will be posting new episodes on Monday, Tuesday, and Wednesday. I've got a really good interview, which should be coming out Monday. And then I got a couple of good episodes coming out on Tuesday and Wednesday. And then after that, I'm probably going to take off for about a week, and I don't think I'm going to post any episodes that following week, that first week in December. There, the December, I think it's the 1st through the 6th. I'm going to take a break off from that during that week, just a little holiday break. I will be back on the 7th, Saturday the 7th, for the next BND Strategy Room live stream. So taking a little well-deserved holiday break there for a little bit, but rest assured, I will be back. I will be back with a lot of episodes in December. I am still working on the financial history series. I kind of have episode 1 figured out now, and I'm going to do it. I was thinking about maybe releasing it on Friday after Thanksgiving, but I'm not 100% sold on that. So I don't know. I might just hold it off and wait until the week that I come back from my little holiday soiree, as they say. So okay. So that's, and basically that's what's happening with that. So, okay, let's get in. I got some big banking news here I wanted to share with everybody. So I wanted to run through some of this stuff. So the U.S. Securities and Exchange Commissioner, Gary Gensler, will step down from the agency on January 20th, 2025. Gensler began his tenure as President Biden's appointee on April 7th, 2021. Shortly after the GameStop market events, a statement from the agency said Gensler's implemented reforms to enhance efficiency, resiliency, and integrity in U.S. capital markets, and that the agency under his watch held wrongdoers accountable and returned billions to harmed investors. Okay. Some people see it a little differently, but that's good. That's all right. Okay. Private lending. I got some update on private lending here. So Bank of America Corp is planning to structure what they call synthetic risk transfers, SRTs. That's basically a fancy term for basically saying that they're going to offload loans off their balance sheet to some other party, which would basically be a private lender. So they're planning to structure their synthetic risk transfers for smaller lenders, a move that could expand the SRT market amid increasing regulatory scrutiny, the Financial Times reported. The bank has been exploring ways to structure SRTs for regional banks in the U.S. and smaller lenders in Europe and distribute them to multiple investors, 6 unnamed sources told the news outlet. Yes, and as I keep saying, the whole private bank thing, like this is going to be a problem, because what they're doing is they're basically unloading their bad loans off onto other lenders. And I keep saying why the primary buyers of this stuff so far have been private equity and hedge funds. Why are they doing that? I understand part of it is a business model. They have to feed the beast, so to speak. But it's just, I just don't understand. Like, they know they're buying bad loans, so this is going to blow up. And when the music stops, who's going to be left without a chair? That's it. And so, but anyway, let's continue on here for a second. So, U.S. banks, including Goldman Sachs Group, Morgan Stanley, and Bank of America, are asking buyers of significant risk transfers, or SRTs, whether they plan to use debt to finance the deals, as leverage could just move the credit risk to another part of the financial system, which worries regulators. Yes, exactly as I've been saying. Citing people with knowledge of the matter. Like other major banks, B of A is not allowing its SRT investors to take leverage from other banks, the report said, citing an unnamed source. So now, let me offer you guys a definition of SRT, significant risk transfer. So these are transactions that encompass a broad set of cash or synthetic securitizations that have proven to be valuable risk management tools for banks to share credit risk with third-party investors, i.e., dump the loans off their balance sheet, such as private credit funds and other private investors, private lending. The SRT is a portfolio-level financial deleveraging strategy that offers banks regulatory capital relief, providing a competitive advantage for insured banks to grow their business. Now, why do they say offers banks regulatory capital relief? Well, because if banks have these loans on their books, they're going to have to set aside more money. If these loans go bad, if they think they're going to go bad, they're going to have to set aside more money to basically more loan loss reserves. That's gonna hurt your capital at the end of the day. You may have to go out and raise more capital to cover those losses. They don't want to do that. Much easier to just offload the risk off the balance sheet to some other third-party lender. Now, what Goldman Sachs and Morgan Stanley and Bank of America are asking buyers is, because again, it's all private equity and hedge funds. And what do private equity and hedge funds like to do? They like to leverage the crap out of everything that they do. So they're asking them, guys, when you come in to give us $100 billion to buy this whole portfolio of loans, are you guys buying that with cash, your cash, or are you guys taking out other loans on top of these loans and adding basically double, triple the leverage to this thing? Because we got concerned that might, blow up, because that might remind us of maybe what happened back in 07, 08, 09. Don't want to go down that road again. Okay. Some crypto news for everybody. So the Commodity Futures Trading Commission's Global Markets Advisory Committee advanced a recommendation to expand the use of tokenized non-cash collateral in derivatives trades through distributed ledger technology. This marks a significant first step toward realizing opportunities for the derivatives market with exactly the same guardrails and protections in place. That's kind of weird. So they're going to use a blockchain distributed ledger technology and expand the use of tokenized non-cash collateral, which, as far as I know, a lot of companies aren't really doing, but this is somehow going to offer the exact same guardrails and protections in place. If anybody had watched the crypto special that I did a few weeks ago, you would know in the reports that I put out there by Financial Stability Board, by the Biz, you would know that a lot of the stuff they said is not safe, is not secure, especially if you have issues in certain parts of the market. So yes, I'm very highly skeptical of all this. Okay, so all right, and then you had the U.S. crypto exchange Coinbase Global is looking to buy more payments-related businesses to expand its capabilities in the space, Bloomberg News reported. And then you have Charles Schwab Corp. President and incoming CEO Rick Wurster said the firm is looking to offer spot cryptocurrency trading once the regulatory environment eases up. So kind of interesting. Citadel Advisors founder and CEO Ken Griffin said he is open to selling a minority stake in the $65 billion multi-strategy hedge fund he formed in 1990 at some point in the future. Bloomberg News reported, citing an interview with Griffin at the Economic Club of New York. Griffin, however, ruled out the possibility of taking the hedge fund's sister market-making firm, Citadel Securities, public anytime soon due to the quilt work of regulatory burdens on public companies. Or I'll offer you an alternative on that. Maybe Citadel Securities might actually start telling people the truth about what they do and how they make money. And that might ruffle a few feathers. Yeah, it might just ruffle a few feathers. But it sounds like Mr. Griffin is getting ready to cash out. Maybe he sees retirement on the option or on the horizon, perhaps. So looking maybe get out of the hedge fund side of it, but we'll see. The Federal Reserve entered an enforcement action with Sean Hayes, the former CEO of failed Eckhart, Kansas-based Heartland Tri-State Bank, after the executive pleaded guilty to embezzlement in federal district court. Hayes is prohibited from joining certain financial institutions without prior written approval from the Fed board. He also agreed to pay $60.5 million in restitution. Now, if you guys remember this, I reported on this episode in the crypto series because this gentleman fell prey to what's called a pig butchering scam. And go see I did an episode on pig butchering. I did an episode on the failure of this bank. So if you want more information with there, go check out those episodes there. And that is in the crypto series. So go check those out. But a really interesting story there. And I just, like that said, I just said that as a kind of a follow up to that. Okay, the Fed's Mickey Bowman basically said in a speech, a crisis is not a regulatory blank check. Promoting safety, soundness, and financial stability should not devolve into an exercise of regulatory allocation of credit, picking winners and losers. So speaking in Florida, Bowman said a balance must be struck in banking regulation and supervision because banks are unique individual businesses, not public utilities. I agree with that. I think that's really interesting. Okay. Federal regulators plan to maintain ongoing rulemaking processes, but not to pursue any new regulatory agendas before the upcoming Trump administration takes office in January. American Border Baker reported. Yeah, kind of no duh. That's everybody kind of knows that's what's going on. Okay. And let's see here. I'm going to get into. This was a good one. This is a good one. The SEC filed a lawsuit against Robert Thompson, a former Federal Reserve Bank of Richmond supervisor, alleging insider trading in securities in New York Community Bank and Capital One Financial Corp., both of which were under his supervision. American Banker reported. The agency also claimed Thompson submitted false disclosure statements about his conflicts of interest, the report said. Robert Thompson, a former senior supervisor at the Federal Reserve Bank of Richmond, pleaded guilty to insider trading with confidential information from some of the banks he was regulating. The department said Thompson admitted in federal court in Richmond that he made the illegal trades and lied to the Federal Reserve by denying he owned shares of publicly traded financial institutions. Yes. So I had reported on this, basically saying I had reported on this months ago. Basically a bunch of the Fed governors that ran. I think it was the Bank of Boston and the bank down in the one in Dallas. They basically got caught with their hands in the cookie jar. They got caught insider trading, and they retired real quick to squash the scandal. Jeremy Powell was even implicated in that scandal, but then they said that, oh yeah, no, he was fine. He didn't do anything, whatever. Yeah, not sure how much I believe that, but allegedly. And so what happened after that scandal broke out was that the Jeremy Powell then came back and said, okay, we are making changes. Nobody in the Fed is allowed to, if you try to do insider trading, you're going to get caught, you're going to get busted, and that's going to be it for you. And so I'm very happy to see that wasn't just, like some BS policy that they put in that worked out. They held a senior supervisor accountable for insider trading and busting them. And I am super, super stoked to see that. Next, they need to do Congress. They need to do Congress next. No more insider trading in Congress. It's ridiculous. And then here's a very interesting one. British regulators launched an investigation into the connections between Jeffrey Epstein and former Barclays CEO Les Staley, sparked by documents from JP Morgan Chase and Company, Bloomberg News reported, citing a London court filing. A London court heard that JP Morgan alerted the UK Financial Conduct Authority, FCA, in November 2019. November 29. What's today? Is it November 2024? November 2019, 5 years ago, about documents linking Staley, a former executive at the bank, to Epstein. The report said this prompted the FCA to formally investigate Staley, leading to his dismissal and a lifetime ban from the UK financial services sector. So, Jez, I think it's pronounced Les. I think it's spelled with a J, but I think it's like Les Staley. He has been implicated in this thing for a long time. And I find it very fascinating that these guys had this hearing back in 2019 and sat on this for 5 years. And now all of a sudden, you have this new administration here in the US coming in, and they might be releasing a certain Epstein list. And now all of a sudden, these guys want to look into Les Staley, and they want to have their investigation. Could it be that maybe Mr. Staley is on that list, and that they are trying to get ahead of the curve here, and they didn't want to look stupid for basically having this guy out there, and then they'd have to answer for questions going, wait a minute, you knew about this. You guys knew about this for 5 years, and you did nothing. What's up with that? So interesting stuff there. So okay, so what do we have here? CFPB finalizes rule on oversight of digital payment apps. So we'll see that there. Builder sentiment rises in November. Housing starts. Building permits fall in October. FHFA enables Fannie and Freddie to expand support for rental housing. Let's see here. Just got a few more things, and then we'll get into a couple more articles here before we get out of here. Chopra, Congress should remove deposit insurance limits on payroll accounts. Yeah, that ain't happening. I'm not going to do that because Mr. Chopra is out the door. He's afuera. If anybody's ever seen that video of Milei down in Argentina, one of the greatest videos I've ever seen. It's actually a press conference where he talked about all the government agencies that he was going to cut, and he had this whiteboard, and he had all these little blue little cutouts on the board for all the different government agencies, and he says afuera, gone, afuera. Yeah, Chopra, afuera. He's gone. He's out of here. Community banks are the backbone of the economy. Andy Barr said, yes, totally agree with that. Yeah, I got some news here on the Farm Bill. So Senate Agricultural Committee Chairwoman Debbie Stabenow released her version of the Farm Bill as lawmakers continue discussing options for the Farm Bill. I have been wondering why this Farm Bill seems like a great thing. And I've been sitting here wondering, why is it taking so long? I mean, this thing has been hung up for years now, sitting there, and I'm going, what's the holdup? What is the problem? And then finally, I heard what I think is the holdup, and I need to confirm this for a fact, but I heard that a huge chunk of the money was actually not going to farmers at all. It was going into the welfare program. It was going into the CHIP program, or SNAP, CHIP, whatever it is. And finally, that it sounds like that is what came out, and that's apparently why a lot of lawmakers would not vote on this thing, because a huge chunk of the money wasn't going to the farmers at all. It was going into the welfare programs, and I finally sat there and I said, that makes sense. That would make sense why a lot of lawmakers would not get behind this thing, why they couldn't find the votes. Because they're playing the old shell game, let's throw some goodies out here for the farmers, but in reality, we're going to send a huge chunk of this money over here to do something totally different. Classic DC there, but I do need to confirm that. I will say I got to pump the brakes a little bit. I need to get a little bit more information. I need to confirm that. So okay. Generative AI increases fraud threat. Yeah. What else is new? Romero Rainey, credit unions' fuzzy math reveals tax exemption insecurity. While credit unions have a history of playing fast and loose with the facts, they now appear willing to say just about anything to distract from the impact of their taxpayer subsidies. Well, yeah, we'll see. District Court invalidates overtime rule. We already got that. Okay. Let's see here. Before I get back to this for a second, this is really interesting. This is really interesting here. So we have this thing called the hippo effect. And this is from Emily McCormick, the editorial and research, vice president of editorial and research for Bank Director. This was a blog post from her, and I thought this was really good. This is really interesting. When Jeff Rose meets with his management team, he never wants to be the first to offer an opinion. Despite being the CEO at American Bank and Trust, the $520 million subsidiary of AmBank Holdings in Davenport, Iowa. Due to his position, he says his opinion carries double or triple the weight. Rose is referring to a psychological concept called the hippo effect, a form of authority bias where a group defers to the highest paid person's opinion, the hippo. This form of bias isn't necessarily about who has the biggest paycheck, but who has the most influence. Maybe it's the CEO, but it could also be a board member with extensive tenure, or a founder or shareholder with a heavy investment in an organization. Once that person speaks, it could shut the conversation down. So what looks like agreement could be deference to the most powerful person in the room. Board members need to understand, especially if they're the large shareholder or if they're just the outspoken voice, that they need to let other folks express their opinions before they express theirs. Psychologist and author Adam Grant once called the hippo the most dangerous voice in a meeting, adding, status disparities can fuel conformity and groupthink. When you need diversity of thought, ask everyone else to share their views before turning to the hippo. That's where chairs and lead directors who are charged with facilitating board meetings and setting the meeting agenda can play an important role by ensuring everyone has an opportunity to weigh in. The business and community leaders who typically serve on bank boards are unlikely wallflowers. Fully 2/3 of the directors and CEOs responding to Bank Director's 2024 Governance Best Practices Survey said they speak more than the average person in the boardroom. A good chair or lead director seeks consensus, and a collegial board can be a positive sign of a productive working relationship. But that person should also engender courage among other directors, even when their opinions seem to contradict the hippo. James Alpin Jr. has been in many boardrooms as a partner at the law firm Bryan Cave Lighton Praisner, and he also serves on Bank Directors Board and on several bank boards. If from time to time you aren't sure whether you're about to be fired from a board for bringing up an issue, then you're not doing your job. He says in an upcoming issue of Bank Director magazine. So the hippo effect, yes. Very interesting. Very interesting bias that could come out. Basically, so if you're the big mahoff, so to speak, in the room, you should let everybody else talk before you render your opinion, as you could have the most weight and people may just defer automatically to your opinion because you're the hippo in the room. So very interesting thing there. And I think I'm going to wrap it up on that note. I think I'm going to end with that tonight. I think it's a good way to end. But I hope people are really enjoying these live streams. I thank everybody so much for watching and spending the time hanging out with me for a little while. I really appreciate it. And as always, remember to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments, as I always love to get commentary and get back to people. Like I said, I will have 3 episodes coming out this week on Monday, Tuesday, and Wednesday. Make sure to watch for those. And then I'm going to be taking my little holiday vacay, my little holiday soiree, as it were. So again, I wish everybody a wonderful and hopefully happy Thanksgiving coming up this week. Be safe out there. If you're traveling, Wednesday is always the heaviest travel day of the year. So if you're traveling, just be safe out there. Get to wherever you're getting in one piece. And like I said, I hope everybody has a great weekend. And I will be back. I'll see everybody. Like I said, look for those episodes next week. And I will see everybody again real soon. Thanks for being in the strategy room.